I need to tell you about one of the most expensive mistakes I see people make, and it happens at age 62. The moment they become eligible for Social Security, they file, they start collecting benefits immediately, and they think they're being smart. They think they're getting money now instead of waiting. They think they're ahead of the game. But the mathematics tell a completely different story. And the cost of this decision, the permanent reduction in lifetime benefits, often exceeds $200,000 for a married couple. $200,000. That's not a theoretical calculation. That's real money that could have funded an extra decade of comfortable retirement. Gone. Because of one decision made at age 62 based on emotion rather than analysis. I've managed retirement assets for 40 years. I've run the numbers on Social Security, claiming strategies thousands of times for clients. And I can tell you with absolute certainty that there are three specific moves that separate people who maximize their Social Security benefits from people who leave massive amounts of money on the table. These three moves are not complicated. They don't require insider knowledge, but they do require understanding how the system works and having the discipline to make optimal decisions even when your instinct is pulling you in the wrong direction. So let me walk you through these three Social Security moves that can add $200,000 or more to your lifetime benefits. Move number one. Delay taking benefits until age 70. If you're the higher earner, this is the single most important Social Security decision most people will ever make. And most people get it completely wrong. Here's how it works. You can start collecting Social Security as early as age 62. But if you do, your benefit is permanently reduced. If your full retirement age is 67 and your full benefit would be $2,000 per month, but you file at 62, you only get about $1,400 per month. That's a 30% permanent reduction. On the other hand, if you delay past your full retirement age, your benefit increases by 8% per year until age 70. So if you wait until 70, that same $2,000 full benefit becomes about $2,500 per month. That's a 25% permanent increase. Now let me show you what this means. In real dollars over a full retirement, let's say you're the higher earner in a married couple. Your full retirement age benefit is $30,000 annually, $2,500 monthly. If you file at 62, you get about $21,000 annually. If you wait until 70, you get about $37,500 annually. That's a difference of $16,500 per year, every single year for the rest of your life. If you live to age 90, that's 20 years of receiving an extra $16,500 annually. That's $330,000 in additional benefits just from waiting 8 years. But people say, wait, if I file at 62, I'm collecting for 8 extra years before you even start at 70. Don't I come out ahead? And the answer is no, not if you live a normal lifespan. The break-even point, where waiting until 70 surpasses filing at 62, is around age 80 to 82, depending on your specific numbers. And if you're 62 and reasonably healthy, there's a very good chance you're living past 82. Life expectancy tables say a healthy 62-year-old man has about a 50% chance of living to 85. A woman has about a 50% chance of living past 87. So waiting pays off for most people. And here's what makes this even more critical for married couples. The higher earner's benefit becomes the survivor benefit. When one spouse dies, the surviving spouse gets the higher of the two benefits. So if you're the higher earner and you delayed to 70, when you die, your spouse continues receiving your higher benefit for the rest of their life. That could be another 10, 15, 20 years. The compounding effect of that higher survivor benefit is enormous. Let me give you a real example. I had a client, a couple, both healthy, both 62. The husband's full retirement benefit was $3,000 monthly. The wife's was $1,500. They wanted to file immediately. I ran the numbers. If they both filed at 62, their combined lifetime benefits, assuming they lived to their life expectancies, him to 85, her to 90, would be about $1.4 million total. But if the husband delayed to 70, and the wife filed at her full retirement age of 67, their combined lifetime benefits would be $1.65 million. That's $250,000 more, just from optimizing the timing. They didn't want to wait. They said, what if we die early? What if we never collect? And I said, you're both healthy. You have good genes. You're not smokers. Statistically, you're very likely to live into your mid-80s. And if you do, waiting is worth $250,000. Are you willing to bet against yourself living a normal lifespan? They waited. The husband delayed to 70. And now at age 75, he's already collecting over $40,000 annually. And when he dies, his wife will continue receiving that amount for potentially another 15 to 20 years. They made the right decision. So here's the rule. If you're married and you're the higher earner, delay Social Security until 70 unless you have serious health issues that make it unlikely you'll live past age 80. The math is overwhelmingly in favor of waiting. Move number 2. Coordinate spousal claiming strategies to maximize household benefits. This is where most couples make critical mistakes because they think about Social Security as two separate individual decisions instead of one coordinated household strategy. Here's what you need to understand. In a married couple, you have multiple claiming options, and the order and timing of when each spouse files can dramatically affect total household benefits. The basic principle is this. The lower earning spouse should generally file at or near their full retirement age. The higher earning spouse should delay to 70. This maximizes both current income while one spouse is still working or living off other assets. And it maximizes the survivor benefit, which will eventually go to whichever spouse lives longer. Let me break down a specific scenario. Husband earns significantly more throughout his career. His full retirement benefit is $36,000 annually. Wife worked part-time or took years off to raise kids. Her full retirement benefit is $18,000 annually. They're both currently 62. Here's the wrong approach. Both file at 62. They start collecting immediately. The husband gets about 70% of his full benefit, $25,000. The wife gets about 70% of hers, $12,600. Combined, they're receiving $37,600 annually. That seems fine. But here's the optimized approach. The wife files at her full retirement age of 67. She gets her full $18,000. The husband delays until 70. At that point, he gets 124% of his full benefit, about $44,600. Now their combined benefit, when he reaches 70, is $62,600 annually. And here's the critical part. When the husband eventually dies, the wife's benefit doesn't stay at $18,000. She steps up to his benefit. She gets $44,600 for the rest of her life. Let's do the math over full lifespans. In the wrong approach where both filed at 62, assuming he lives to 85 and she lives to 92, their combined lifetime benefits total about $1.75 million. In the optimized approach, their combined lifetime benefits total about $2.05 million. That's $300,000 more. And this doesn't even account for inflation adjustments. Social Security benefits increase with cost of living adjustments every year. A higher base benefit means those percentage increases are applied to a larger number, so the gap actually widens over time. Now, what if the wife needs income before the husband turns 70? There are ways to handle this. The couple can live off retirement savings, withdraw from IRAs or 401ks for those years between when the wife files and when the husband files. Yes, that depletes the portfolio slightly, but the increased lifetime Social Security benefits more than make up for it. At BlackRock, when we build retirement income plans for couples, we always model multiple Social Security claiming scenarios. We look at both spouses filing early, one late, both at full retirement age, both delayed, and we calculate the total household lifetime benefits under each scenario. Almost always, the optimal strategy is for the lower earner to file at full retirement age, and the higher earner to delay to 70. The only exception is if there are significant health issues. If the higher earner has a serious condition and is unlikely to live past 75 or 80, then filing earlier makes sense. But for healthy couples, the coordinated delay strategy adds anywhere from $150,000 to $300,000 in lifetime benefits. Move number 3. Time your Social Security. Start to avoid tax traps and maximize Roth conversions. This is the most sophisticated of the 3 moves, and the one that almost nobody thinks about, but it can save you tens of thousands of dollars in unnecessary taxes and Medicare premiums. Here's the issue. Social Security benefits are taxable income, but they're not always taxable. It depends on your total income in a given year. If your combined income, which is your adjusted gross income plus half of your Social Security benefits, exceeds certain thresholds, then a portion of your Social Security becomes taxable. Up to 85% of your benefits can be taxed at your ordinary income rate, and it gets worse. Social Security income counts toward the income thresholds that determine your Medicare Part B and Part D premiums. This is called IRMA, Income-Related Monthly Adjustment Amount. If your income exceeds certain levels, your Medicare premiums can double or even triple. So here's the strategy. In the years after you retire, but before you start taking Social Security, your income is very low. You're not working. You're not taking Social Security yet. You might just be living off savings or doing small Roth conversions. This is the golden window for tax planning. During these years, you can do large Roth conversions, moving money from traditional IRAs to Roth IRAs, and pay very low taxes because you're in a low bracket. You can also strategically withdraw from taxable accounts, harvesting capital gains at 0 or 15% rates. But once you start Social Security, your income goes up. Now those Roth conversions push you into higher tax brackets. Now capital gains might be taxed at higher rates. And now you might trigger IRMAA surcharges on Medicare. Let me give you a real example. You retire at 62. Your only income is $20,000 from part-time consulting. You're married filing jointly. You can convert about $70,000 from traditional IRA to Roth IRA and stay in the 12% tax bracket. You pay about $8,400 in taxes on that conversion. That's a great deal. You've moved $70,000 into a tax-free account forever. You do this for 5 years, from 62 to 67. You've converted $350,000 from traditional to Roth, paying about $42,000 in taxes total, all at the 12% rate. Then at 67, you start Social Security. Now your income is your $20,000 consulting, plus $30,000 from Social Security. Your taxable income is much higher. If you tried to do Roth conversions now, you'd be in the 22% bracket. You'd pay nearly double the tax rate. Plus, large conversions might push you over the IRMA thresholds, and your Medicare premiums go from $174 monthly to $244, or even $349. That extra premium lasts for the entire following year. By timing your Social Security, start to allow for maximum Roth conversion years beforehand. You accomplish multiple goals. You move more money into tax-free Roth accounts. You pay lower tax rates on those conversions. You avoid IRMAA surcharges. and you reduce your future required minimum distributions because you've shrunk your traditional IRA balance. The total tax savings from this strategy over a retirement can easily be $50,000 to $75,000. Plus, you create hundreds of thousands in tax-free Roth assets that you'll never pay tax on again. At BlackRock, we coordinate Social Security timing with tax planning for every single client. We don't just ask, when do you want to file? We ask, what's the optimal filing date, considering your entire tax situation, your Roth conversion opportunities, your Medicare premiums, and your long-term estate plan. Let me bring all three of these moves together. Delay Social Security to 70. If you're the higher earner, coordinate spousal, claiming to maximize household lifetime benefits, and time your start date to avoid tax traps and maximize Roth conversion opportunities. These three moves are not theory. They're proven strategies that add $200,000 or more to retirement wealth. But they require discipline. They require you to think long-term. They require you to make decisions based on mathematics, not emotion. Most people don't do this. Most people file at 62 because they're scared. They think Social Security might run out. They think they might die early. They want money now. And I understand those fears, but the data doesn't support them. Social Security is not running out. Even in the worst-case scenarios where the trust fund is depleted, benefits would only be reduced by about 20%, not eliminated. And most healthy 62-year-olds live well into their 80s. So the question is, are you willing to make a $200,000 mistake because of fear? Or are you willing to look at the numbers, understand the system, and make the optimal decision? I've spent 40 years helping people navigate these choices. The clients who maximize their Social Security benefits, who get every dollar they're entitled to, are the ones who treated this decision seriously, who ran the numbers, who coordinated strategies, who thought about household optimization, not just individual benefits. The ones who left money on the table are the ones who filed impulsively at 62 without analysis, who didn't coordinate with their spouse, who triggered unnecessary taxes and Medicare surcharges because they didn't plan. Social Security is the foundation of most people's retirement income. For many retirees, it's 40 to 50% of their total income. Getting this decision right is not optional. It's critical. And the difference between optimal and suboptimal claiming can literally be the difference between a comfortable retirement and a struggling retirement. You have one chance to get this right. Once you file, the decision is largely irreversible. You can't go back 5 years later and say, I wish I'd waited. The reduction or increase is permanent. So before you file, run the numbers. Understand your options. Model different scenarios. And if you're married, think household strategy, not individual benefits. These three moves, delay to 70, coordinate spousal claiming, time your start for tax optimization. They're not complicated, but they require planning. $200,000 is on the line. Don't leave it on the table.